Hello and welcome to the latest episode of Damien's Market Update, the show where I talk about what's been going on in investment markets and what to look out for in the days, weeks and months ahead. Now, if you find this useful or interesting, make sure you hit that like button, but also subscribe to the show so you get all future episodes. And also don't forget to ask any questions or leave any comments below and I'll get back to you. So a lot has happened since my last market update. Of course, the biggest story was the US debt ceiling. Now, ahead of that key June deadline when the US government was supposedly going to run out of money and be unable to pay the interest on its debts or function properly, bond markets remained cautious, even if equity markets were far more optimistic that the disaster would be averted. Ultimately, a deal in Congress was struck and talk of the US debt ceiling has been kicked down the road for another 2 years, so panic over. Now, as mentioned, equity investors remained steadfast in their opinion throughout May, confident that a resolution would be materialising. Now, the sentiment was reflected in stock market returns for the month, with the Nikkei 225 showing remarkable strength driven by yen weakness against the US dollar, while the Nasdaq 100 soared higher on the back of investor enthusiasm for artificial intelligence stocks, with Nvidia leading the charge. So if I look at some numbers here, the Nasdaq 100 was up 7.6% in May, and the Nikkei 225 was up 7% during May, while the S&P 500 was up just 0.25%, but it was broadly positive. Of course, you look across the rest of the world, it was a bit of a mixed picture, with the FTSE being the laggard at minus 5.3%. But as we moved beyond the debt crisis, there was a collective sigh of relief, and at the start of June there were reasons for optimism. The S&P 500 had already surged nearly 12% in 2023 by that point, and that demonstrated the considerable strength within the market. And interestingly, historical data suggests that since 1950, when the S&P 500 posts gains of at least 8% in the first 100 trading days of a calendar year, the index has averaged an additional 10% gain for the remainder of the year. In recent videos, I have also highlighted the outperformance of European equities and their significance as drivers of portfolio returns. Notably, the German DAX entered a new bull market in February, having surged 20% from its recent low. Now, the S&P 500 has finally achieved the same milestone. Now, despite the optimism during the first 2 weeks of June, investors were eagerly awaiting the next moves from central banks as well as the latest inflation data for their domestic economies. In summary, this week we've seen the US Federal Reserve pull off what is being called a hawkish pause, which essentially means deciding not to raise the main interest rates after annual inflation in the US, as measured by the CPI, fell to 4% in May, which is the slowest since 2021, March 2021 I should say, and half of the UK's current inflation rate, which is 8.7%. But the associated projections that were produced by the Fed showed that there will be probably 2 more hikes of 0.25% later this year. So the message was that the Fed would pause for now, but would continue hiking later. Meanwhile, the European Central Bank raised its interest rate by 0.25% once again, and like the Fed, left the door open to more hikes in the future and as soon as next month. But investment markets had already been pricing in that central banks might have to hike rates more aggressively than previously anticipated. In fact, the market began betting even before this week's Fed announcement that the Federal Reserve would be compelled to raise interest rates again by July. But the real pain is being felt in the UK, with the Bank of England now expected to raise the base rate to around about 5.75% by the end of this year, going into the beginning of next year, which is up from the current level of 4.5%. Now, these expectations have exerted upward pressure on bond yields, especially in the UK, where gilt yields have surpassed the chaos we saw in the aftermath of that ill-fated mini-budget in the spring, and we saw the Bank of England have to intervene in gilt markets back then. But at the moment, we're seeing yields go above those levels, and it's causing chaos in the mortgage market as well. Now, the Bank of England is due to meet next week to decide its latest policy decision. So will it raise rates again? It is expected to raise its base rate by at least 0.25%. next week, and it finds itself in a tough spot right now. And who's to blame for the rising gilt yields? Well, at the moment it is the Bank of England. But if you want a sense of where investment markets are right now, what's driving them, then you should have a look at the CNN Fear and Greed Index. Now, this is an index that compiles a bunch of data. It's something you wouldn't use scientifically, but it does give an idea if fear is the overriding emotion driving markets or greed. Now, a month ago, it was at a modest 58, reflecting a really more balanced sentiment, but now we're looking at an extreme greed level. So we're up around about 78 when I last looked. So greed is driving the market, and there is a lack of fear also present. If you look at the VIX, so that volatility index is a measure of expected stock market volatility in the US and is often referred to as the US stock market's fear gauge. Now, this week it fell to its lowest level since February 2020. Now, with the S&P 500 now in a technical bull market once again, alongside similar stock market optimism elsewhere, particularly in Europe, as I've already mentioned, the DAX, there is a fear of missing out, the FOMO that's driving markets. And the Bank of America recently published research to show that the buy the dip mantra is on for its third best year this year, the third best year on record. And we even saw investors buy the dip after that hawkish surprise this week from the Fed when they announced their latest interest rate decision. So investors have seemingly put 2022 behind them. If you recall, if you bought every dip in 2022 in the stock market, you were punished quite severely. 2023 is now very different. Now, another reason for optimism is that we've seen a significant increase in breadth in particularly US stock markets, which means that other equity sectors have begun to outperform things like tech stocks, which had been driving the market higher almost on their own in 2023. We've even seen US small caps start to outperform tech stocks on occasion in the last few weeks, as we see money flow back into those regional US bank stocks that had been heavily hammered when we had that wobble back in March when there was talk of a banking crisis. Now, the current positive signs of breadth suggest that sector rotations are taking place, so people are moving out of one sector, typically tech or something similar, into sectors that were unloved, and that is what drives bull markets. And if we look at the year-to-date numbers, there are some quite impressive numbers. The Nasdaq is still up 38.81%, but we're seeing some broader rallies, which has driven the S&P 500 up to 15.27% year-to-date. The Nikkei 225 is up 27.38%, and even the FTSE 100, which is the laggard, if we go down to the bottom, is up 2.37%. If we want to look at the German DAX, then that is up around about 7.53%. So it is the things that were unloved perhaps last year that are doing particularly well this year. But often with extreme greed and lack of fear comes complacency and overconfidence. So concerns remain that the US government's impending borrowing spree, which follows the resolution of the debt ceiling fight, could put renewed strain on the US banking system. So could the banking crisis be about to make a return? Who knows? Keep an eye out in the coming months. Also, the last time we saw the fear and greed index hit these levels was at the short-term market high at the start of February this year, before the market pulled back. Meanwhile, the VIX has hit lows we've not seen since February 2020, and that happened to be just days before the fastest bear market unfolded because of the pandemic. So in conclusion, the current market environment reflects a mix of extreme greed, optimism and complacency. And while sector rotations and improved breadth are positive indicators, investors should remember that markets eventually have a nasty way of humbling even the most confident investors. So don't be surprised if things pause for a while in equity markets or pull back, as markets can't go upward like they are forever. But those who have been betting against equity markets of late have been left licking their wounds. So that is it for this month on Damien's Market Update. As ever, do leave comments or any questions, but if you found it useful, please hit that like button and also subscribe to our channel.